and welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. Today is Friday, March 20th, 2026. We have a great show for you tonight. As always, we want to thank you very much for being here. As you know, this is a show about you and your money and all of the fun points in between. Before we dive into the show, I'll just give you some housekeeping notes and a quick reminder. If you don't get the show in your city, you can go to GaryK.com, listen live or archive. We are live Monday through Friday, 6 to 7 p.m. Eastern. Also at GaryK.com, you can follow Gary on X, formerly known as Twitter, just by pressing the button, or you can follow him at his name at Gary Kaltbaum. You can get him that way as well. You can also subscribe to Gary's morning notes sent directly to your inbox each and every day. Email him, ask him about his money management services, or anything else you want. All of that's available on GaryK.com. If you want his premium newsletter, his members only area where he updates members several times a day with actionable ideas, intraday and daily webcasts where he shows you the charts. It's great listening to Gary on radio, but seeing him talk while seeing the charts as well, that's a really, really big added value for many folks. That's available at convictionleaders.com. That's convictionleaders.com. All right, a few notes from Gary. I'm going to dive right in here and be the messenger and report them. Clearly, defense is primary. I mean, those are my thoughts. Defense. But let me read to you what Gary sent me. A big wild card now is that interest rates have broken out to the upside and had a decent spike to the upside today. And leave no doubt the market didn't like it. We think this is more than just the war, because the last inflation number that spiked was a number before the war even started. There is no way the Fed can lower rates aggressively, and if rates get out of hand, they may be forced to do the opposite, which is raise rates. That's how free markets work, and we worry that the new guy is just going to do what the president wants to do, which is lower rates no matter what. Higher rates really affecting technology today. Software has already been in its own private bear market. You don't want to see the rest head that way, and today was a rough day. So those are notes from Gary about today's action. And he brings up a brilliant point about interest rates potentially, for the Fed. If the Fed has to raise rates to combat inflation, that's going to pretty much change the narrative that we've been operating with for a very, very long time, that the Fed's going to cut rates. So now that oil is high, the headline right now on a lot of the news websites, the Wall Street Journal, wherever you want to go, is Pentagon sending more Marines, warships to the Middle East. So if what does that mean for oil prices? Most likely oil prices will be going higher, not lower. I think in some parts of the country, it's $5, $6. I mean, gas is up a lot. Gasoline prices at the pump. Gasoline futures are up a lot as well. So we're in a situation right now where defense, folks, is key. I mean, I can go through and I'll give you a lot to cover here, play by play, as Gary does with the radio show and he does on Conviction Leaders. Just go help you understand so you can listen to the market. I have a book. It was number one on Amazon every day for 3 months. I'm happy about that. And thank you everybody who supported it and left a nice comment. The Psychological Analysis is the title of it. So if you're familiar, there's fundamental and there's technical analysis. Fundamentals like Warren Buffett, you study the company and you look for the metrics of a company, earnings, revenue, so on and so forth. And then technical analysis, you study the stock. And you can have a good stock and lousy company with no earnings growth or loses money, and vice versa. A company with great earnings growth, but the stock's going down. So technical analysis is really a good way of just being objective and looking at price and volume of the stock. Those are the two big schools of thought. So my contribution to Wall Street is psychological analysis. After years and years and years of studying both of those schools of thought, fundamental and technical, I realized there's something missing. And this is, it's that psychology, right? So the idea is, in one simple way, is the elevator pitch for the book is teaches people how to make rational, not emotional decisions with their money. And the whole point of doing that is being able to listen to the market. I say in the book, there's an infinite number of ways to make money in the market. Your job is to find one that works for you. I also say in the book, the market's speaking. And then I ask, are you listening? And the reason why I ask that question is because the market's not going to verbally speak to you the way that I'm speaking to you, or the way that Gary speaks to you, or any other human speaks to you, or the way you speak to other humans. It's nonverbal. And most human interaction, I could be wrong, but Google this and trust but verify, like Reagan taught us, verify everything. Most human interaction, I'm told, is nonverbal. The market isn't directly yelling at you, buy, sell, hold. No, it's nonverbal communication. The way that the market's speaking is by price and volume action. All things being equal, there's something, there's moving averages. As a quick refresher, it takes the last closing price for X number of days, the 50-day moving average or the 200-day moving average or the 21-day moving average or any other moving average you want. Let's just use the 200-day because it broke it today. You take the last 200 days, the closing price, and you take an average and you smooth it out. And that becomes a line. The 50-day moving average, same thing. The 21-day, same thing. The longer term moving averages, like the 200-day, the 150-day, the 100-day, the longer the moving average, the slower it is, because you need more days for that moving average to move. Like 200 days is 200 days. A 5-day moving average is only 5 days. So it's much more sensitive and can move a lot more, faster is the word, not frequently. I was going to say frequently, but it's faster. So the shorter term moving averages move faster than the longer term moving averages. And the reason why the longer term moving averages are there, and you could think of them as somewhat as guardrails, is that they help us understand, all things being equal, the state of the market. And the state of the market changes up and down. So when you're in a bullish environment, typically, the 200-day moving average is sloping higher, lower left to upper right, and the 50-day moving average is doing the same thing, and the 50 days above the 200-day, just for the sake of simplicity. Same is true in a stock, an ETF, the market, the NASDAQ, the S&P, just 101, technical analysis 101. Now, when the price is above the 50 and the price is above the 200 in that situation, when the price gets below the 50, like what's been happening over the last few weeks here, if not month and change, before the war even started, then all of a sudden something happened, something changed. Then you've been living below the 50 for a while. That's the market speaking. If you look at the QQQ, you can see it, the NASDAQ 100. For the last several weeks, 1, 2, 3, 4, 5, 6, 7 weeks, 8 weeks now, if not more, you've been living below the 50. And then yesterday on Thursday, you touched that 200, closed just near it, and then a day like today, Friday, boom, you break the 200. It's not all of a sudden out of nowhere. No, this has been happening for a while. In fact, the market's been going sideways for about, 4, 5 months, 6 months now? Since October. We had a ginormous, if that's a word, a massive rally from April last year until October, moved sideways since then, and now we're going down to test support near that 580 level. But we broke the 200-day. So, okay, defense. It was since we broke the 50-day. I've been saying defense. Gary as well. Why? Because, somebody told me one time, nothing good happens at nighttime, right? From a, teaching kids and young kids and go to bed at night type of a thing. Same thing here, nothing good happens below the 50-day. And really nothing good happens below the 200-day. Just because it broke the 200 doesn't mean it's over. Doesn't mean, oh no, go away. No, it's just a time to be a little defensive. And that can change, right? But for now, it's just defense. This too shall pass. It always has if you look at market history. Even last year, we fell hard in the first quarter. We bottomed in April, and we shot higher. Could that happen again this year? Yeah, of course. Anything is possible. Could we go into a correction, a pullback, a bear market? Anything is possible. If you would have asked me last year in March, do I think we're going to have a huge rally from April to October? Probably I would have said no. But when the facts change, I change. Lord Keynes said that, a famous economist from way back when. And then he asked the question, rhetorical question, what do you do, sir? So for now, I'm defensive. If and when the action improves, we get back above the 200-day, we get a new follow-through day, we get above the 50-day, and more leadership shows up, more breakouts show up, so on and so forth, then things will improve. Until then, not much happening. So it's really important to put things in perspective and stay aligned with the market. That's it. It's really that simple. If you fight the tape, if you fight the market, you end up losing. Most humans, I've yet to meet one that can consistently fight the market and win. Defense, 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 defense. I mean, I can say that 100,000 more times. When the environment improves, we'll adjust accordingly. Up next, we've got a lot more to cover. I'm Adam Sarhan, and this is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, I'm Adam Sarhan, in for Gary K, who's out today. You can go to GaryK.com and listen live or archive basically 24/7 on any device that has internet, anywhere in the world. So we spoke about the fact that the market is in a defensive state right now. Remember, the states change. High level of some education here. There's 3 states that the market can be in. Again, this comes from my book directly. And if you want to pick up a copy, feel free. It's Amazon. You can go to Psychological Analysis or type my name in, Adam Sarhan, on Amazon. And there's 3 states. The market can go up, it can go down, and it can go sideways. That's it. Literally, that's all it can do. Up, down, sideways. Same thing with any stock. Same thing with any publicly freely traded market. Commodity, stock, currency, doesn't matter. Crypto, doesn't make a difference. As long as it's freely traded, there's supply and demand, there's price volume, it can go up, down, or sideways. Doesn't matter if it's Apple, if it's Amazon, if it's an oil stock, a gold stock, it doesn't make a difference. Up, down, sideways. The idea, simplest forms, is to be aligned with the broader trend. Be long in a bull market. You know, when the market's going up, that's an uptrend. You want to be long. That's how you make money. When the market's going down, you kind of want to get out of the way if you're an active trader. If you're a long-term investor, complete different story. People that are dialed in and focused, I'm assuming Gary's audience, are not going to sit back and watch a stock go down 30, 40, 50, 60, 70, 80, 90%. So you want to be long in a bull market. You want to be flat or out in a bear market. And sideways choppy environment, it's up to you and depends on your cushion and your risk tolerance and your conviction and so on and so forth. But typically in a downtrending market, like we are now, the last few weeks, the market's been going down, sideways to down. I'm not looking, my whole thing, be defensive. I'm not looking to take on new risk. Oh, I'm going to go all in right now. Yeah, no thanks. I much rather be aligned with the market. Again, that's a play on words here, what I'm about to say. Be in harmony with the market, not just harmony, but harmony. It's a play on the word harmony with the market. And be long when the market's going up, and be out or flat or reduce my exposure depending on the situation in a downward trending market or a sideways environment. That's all. That's simple. How do I know? I don't for sure know. Nobody does. Nobody knows what's going to happen tomorrow, next week, when the market's going to close in a year. Nobody knows. And that's okay. You don't have to know. When I understood that, I had this huge breath of just relief. This sense of like, whoa, it's okay not to know? Yeah, it's okay not to know. Why? Because look at nature. And by the way, it's also, before I talk about nature, it's also okay to be wrong more than you're right, as long as your losses are small and your wins are bigger. And I learned this from nature and from the market. Nature has, let's say you have an apple tree, has 1,000 seeds. I'm just going to exaggerate to illustrate a point here. 999 of those seeds die. Now that's okay. One seed becomes a new apple tree, and you get another 1,000 seeds, 999 die, another one seed, becomes a new apple tree, so on and so forth, and nature flourishes. Even though the vast majority of those seeds die. That's okay. Why? Because when you're wrong, what does nature lose? It loses one seed. That's okay. When it's right, potentially infinite new seeds. You get another apple tree, same thing, rinse, wash, repeat, so on and so forth. And nature flourishes. Trading can be the exact same situation. If I have 10 trades, again, I'm going to exaggerate just to illustrate the point. There's two traders, trader A and trader B. Winning trader and losing, trader A and trader B. There's 10 trades. 9 of those trades lose, 1 wins. Which one would you want to give money to? The other trader had 9 wins and 1 loss. Which one you want to give money to? Well, of course, Adam, the one with a 90% win ratio, 9 wins, 1 loss, I'm in. Pause for a second. Really? You don't even know how much they lost when they're wrong. And you don't know how much when they won when they're right. So to illustrate the point, and again, I'm exaggerating here, but just to stay with me here, just to illustrate the point. You have 10 trades, 9 don't work. You lose 1 9 times, you're minus 9. The 10th one, you win 10. Net, you're up 1. But you lost 90% of the time. Net, you're up 1. The other guy, or gal, won 9 times. So they're up 9. The 10th trade, they lost 10. Net, they're down 1. Even though they had a 90% win ratio, means absolutely nothing in the real world. Why? It's the size of the win compared to the size of the loss over a series of time. That's what matters. Not the percent winning or percent. Look at baseball, same thing. The best baseball players in the world do what? Hit 3 out of 10 pitches, thereabouts, and they're phenomenal. They strike out 7 out of 10 times too, and that's okay. Nature doesn't know which seed is going to work. Otherwise, you just have 1 seed and you're done. There's 1,000 seeds come out, millions of seeds, whatever it is, right? Again, I have no idea. A gazillion billion seeds. Doesn't matter. You just need 1 to work. Providing when you're wrong, all you lose is 1 seed. When you're wrong in that example, you lose $1, 1 unit of risk, 1%, whatever that looks like for you. Feel free to have it look like that way for you. Some people risk 20 basis points, which is a fraction of 1%. Some people risk 0.5%. Some people risk 1% of their overall portfolio, because ultimately that's what matters. I could say, I'm going to buy this stock, and if it goes down 10%, I'm out. Okay. So you buy it at 100, you sell it at 90. That's a protective stop. And I did that initially. I'd risk 7% or 8% of my portfolio on any given idea, but I had no idea how to position size. And I would take a position that was way too big, and I would lose 7 or 8% and do that 2 or 3 times. And all of a sudden, I'm down 20 or 30% of my portfolio. Thankfully, that happened early as a teenager when I didn't have a lot of money and it didn't make a big impact. But I learned the lesson real quickly that position sizing matters. What really matters is what is the impact going to be if I'm stopped out at 7% or 5% below my entry or 10% below my entry? What's the impact on my portfolio? Is it 1% of my portfolio? Is it half of 1%? A tenth of 1%? A 20th of, 10 basis points, 20 basis points? Whatever it is, that's fine. But know that number. Why? Because that's what's going to matter over the series of time. And knowing when to trade is just as important as knowing when not to trade. You don't have to force the issue. If you're not aligned, take a break. There's no need to trade every day. In fact, some of the best traders know that, and they don't. Trade a few times, windows open and close. They call it trading windows. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K., who's out today. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience on any device you want. All right, a few things happening here. Number 1, defense is key. Number 2, we spoke about timeless lessons that can help you when you navigate the market. I always like to say the market's speaking and then ask, are you listening? And here's how I listen to the market. I'm going to go in more detail. So I created the biggest institutions in the world. Let me back up for a second. Wall Street, traditional Wall Street, they use terminals to win. Bloomberg terminals, Icon terminals, they have their own terminals, right? Excuse me. So I decided to create my own terminal, and it's called marketterminal.com. Feel free to check it out if you want. It's a very helpful tool that I use every day. to help me listen to the market. So, market terminal. First thing up is divided in half. You'll see the screen. The left-hand side is to help you find new ideas. The right-hand side is to help you research those ideas. So, left-hand side, first thing we show is breakouts. Every day there's stocks breaking out. Even a day like today, where the market's breaking the 200-day, getting clobbered, so on and so forth, you still have stocks breaking out. They happen to be a lot of oil and gas and energy stocks, but that tells me right away where the leadership is. So some of the stocks that broke out today, CQP. This is a oil and gas energy stock. Next one, VNOM, Viper Energy, another energy-related stock. Planet Labs, ticker symbols PL, aerospace and defense stock. Now, again, these are not buy and sell recommendations. These are nothing to do with, I just want to see what stocks are breaking out. Because we have technology, these are tools, algorithms, AI, all this fun stuff, all built in right away. You got breakouts just like that. SEDG, S-E-D-G, Solar Edge, ticker symbol SEDG, broke out today on Friday. And guess what? That's a solar stock. Why is solar stocks attractive now and catching a bid? Because when energy prices go up, it makes solar a lot more attractive on a relative basis. And that happened in 2007 into 2008, where oil prices in 2008 jumped to 150 a barrel, and solar stocks were one of the strongest groups in the market right before the 2008 crash. Solar stocks and potash and fertilizer stocks, interestingly enough, and then some shipping stocks back then too. So solar stocks could be coming around here, coming up as a new potential theme or a new sector, depending on the environment, depending on the market and interest rate. But just real simple, oil prices go up a lot, gas prices go up a lot. People are going to look for alternatives that make solar more attractive. That's the thesis. Next stock that broke out today is Scholastic Corporation, SCHL. That's a big breakout in the lower half of the range, but we'll see what happens over the next few days and weeks here, but it's a breakout. Scholastic books. I mean, when we were kids, we used to read them. Okay, great. My kids read them today. They have book fairs and all that fun stuff. Another breakout today was ANNA, A-N-N-A. This is another oil and gas stock, a lower price stock, $7 stock. Market cap's about $300 million. Big breakout. It went from 2 to 7, or almost 8 in the last 2-3 weeks. Or 4 weeks, 5 weeks here, as oil prices and energy prices have been just going up. Natural gas supplies in Italy. Wow. All right. So those are the breakouts today. That's it. Just 6. Now, there's also a breakdown section on Market Terminal, and we've got 89. Not joking. 89 breakdowns and 6 breakouts. What is that telling me? Clearly, the bears are in control. We have a live news section we just added. Shows you the number of breakouts compared to the number of breakdowns. Number of movers up compared to the number of movers down. By the way, I'm recording a little bit before the close here. This updates in real time. So after the close, you go look at it over the weekend, you might see the number of change by the time the market closes. It's all real time, live. So we get 3 breakouts, 2 breakouts, 8 breakouts. You can see everything in real time. Movers, we've got 19 stocks moving up right now and almost 470 stocks moving down. All that is just looking at stocks that are up 3% or more and down 3% or more. That's it. 19 up, 473 down. Wow. Stocks gapping up today, we have 8. 13 stocks gap down. 68 stocks making new 52-week highs, 271 making new 52-week lows. What is that telling me? Overwhelmingly, the bears are in control today. Now, could that change? Yes, absolutely. But I don't want to fight the tape. I want to be aligned in harmony with the market. This is how I listen, folks. Every day there's stocks breaking out. Every day there's stocks breaking down. Am I aligned with it? Breaking out is, imagine the concept of resistance and support and resistance, right? So let's say a stock trades between, for a simple way to illustrate the point, 100 and 105 for 6 months. 105 would be resistance, 100 would be support. A breakout would happen when it breaks above 105, ideally on heavy volume. A breakdown would be if it breaks down below 100, ideally for the bears on heavy volume. So That's a concept of breaking out, breaks out above resistance, breaking down, breaks down below support. So some of the breakdowns, Meta is breaking down today, breaking down below 600 of support. SMCI is another breakdown today. And again, I'll just read some of the stocks that are breaking down. There's a lot more. There's over 90 now, but I'm not going to go through all of them, but just go through some of them. SMCI was down over 30% today at some point, just a big move down. And that's a big AI stock, right? Next one, let's see that I can share with you that matters. NLY, Annaly Capital Management, they're a big real estate stock and mortgage. Guess what? They're down a lot. Then I go look at, on the breakdown list, I got DHI breaking down, DR Horton. 2 below that, and I got Baidu breaking down. Toll Brothers is breaking down and breaking below the 200-day. Lennar breaking down from a bearish base under base pattern and then getting knocked down. What does that tell me? Well, let me go look at the XHB. Again, this is how I listen to the market in real time. Oh, the XHB broke down yesterday and broke down even more today, and it's way below its 200-day and way below its 50-day. That's housing stocks. Well, rates go up. What's going to happen? Mortgages, they go up. What's going to happen? Demand probably go down. So real estate prices, home prices, if this continues and housing stocks continue to get mauled here and continue to go down a lot, the spring housing market's on, but mortgage rates just shot higher. All right, that's one of the headlines on the financial news today. Okay. Again, just listening to the market. Before I read the news, I could see it. The market's speaking to me. That's how I listen to the market, folks. I hope that makes sense. You can look at movers up. We got 25 right now, and then movers down. There's, let's see here. Geez, there's almost, there's a lot, over 400. So however you want to cut it, you want to dice it, it's up. To me, it's just look for themes, right? The market's speaking. How do we connect these dots? Those are the housing stocks. By the way, there's 90 breakdowns today. I just gave you a handful. There's a lot more. So when you see a lot of things break down like that, that tells me, oh, okay, hold on a second here. There's areas to avoid, right? There's areas you want to lean into. Like right now, it's extended, but we know energy tends to be working. So let's look at the XLE. Oh, had a huge run from 46 to about 60. I'm not going to touch it now, but had a big run. The OIH, oil service stocks, went from 280 to 406. Huge move. The XOP, another ETF that tracks oil or energy, oil and gas exploration stocks, went from 139 it broke out to 177 or 178. Again, knowing where to be is just as important as knowing where not to be. Some of these, I'll go through some more sectors a little bit later, but some of these areas to avoid, they broke the 50, they broke the 200-day weeks ago, even before the war, right? So it's not like, oh, all of a sudden, it's because of energy prices. Yeah, sure, but listen to the market. The market's objective. Price, volume, they're facts. It's not my opinion. It's not, it's what's actually happening in the market. And to me, that's a game changer. Sure, I'd love to listen to my own opinion, but I trust the market's opinion more. Not mine, the market's. My job, listen to the market and then get aligned with the market, get in harmony with the market, and think long term. Buffett taught us to think in decades. Decades, not days or weeks or months or years, decades. That's where real compounding takes place. Knowing when to be in and when to be out allows you to compound in ways that are just absolutely remarkable. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. All right. So here we go. So I'm just waiting for that music to end. Thank you very much for being here. As always, everyone, if you missed any part of the show, you want to listen again, or if I went fast over something, you want to pause or rewind, please go to GaryK.com. You can listen for free on any device you want, anytime you want, all on GaryK.com. All right. So In closing here, we have only a few minutes left. Again, defense, defense, defense. If you're looking to, I like sharing timeless lessons. I don't come on often, but when I do, I want to just zoom out, share timeless lessons with you. I did a few of those today. The market speaking, I always ask, are you listening? Being in harmony with the market, just some of the things that I've covered. But if we go into an aggressive selling stage, please understand fear possibly could take over. And if that happens, the logic, we all think we're humans, humans are logical creatures, but if you look at our actions, we tend to be emotional creatures and use emotional logic, or if you look at psychology, they call it confirmation bias. You find logic that supports your emotional decision. So, for example, most humans are overweight in the West. Okay, great. Well, why are they overweight? We're looking at a new diet, this, that, and the other thing. Atkins way back when, or keto diet, or this diet, paleo diet, whatever, right? It's calories in versus calories out. Simple logically, you would think most people would be underweight, just control the calories, right? Have less calories, burn more, less coming in, more going out. It's a real simple formula. Most people are overweight. Why? Because it feels, notice my language, feels is an emotion, feels good to eat. So I'm going to eat more. And then do that every day. What happens? It compounds. I left off just a few minutes ago speaking about compounding. Everything in life compounds. Every year I get to give a speech give a presentation about career day at my kid's school, and I ask them, how many wonders of the world do you think there are? And everyone's like, oh yeah, 7. Here's the 8th, compounding. Everything in life compounds. And I give them a slideshow that shows them how money can compound over time. They're 12 years old, 13 years old, 7th graders or 8th graders, whatever it is. Usually 7th grade is what I speak to. And I show them, I say, hey, the average retirement age is 65 in America, and blah, 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 do the math. If you just invest $1,000, here's compound out, show them the numbers, how it can grow. 10,000, here's what happens, so on and so forth. And then at the end, the kicker, if you will, where I get the head, the head emoji when their heads explode type of a thing, not literally, but figuratively. Okay, well, they really get them to be like, aha moment. Because I'm saying everything in life compounds. Your knowledge compounds, your relationships compound, your education compounds, your habits compound. W habits, winning habits compound, losing habits compound. So go back to the logic and emotional thing. Humans, we make emotional decisions. We justify it with emotional logic or faulty logic just to justify our preconceived notion that's an emotional decision. Oh, I want X. I want to eat the cookie. Well, all right. I also want a 6-pack. Well, all right. What do you want more? Look at your actions. Actions speak louder than what? Words. Well, again, if you just look at the actions of humans or the market objectively, it's deafening. It speaks volumes. Screaming. Why? How many sit-ups did I do today, Adam? 0. How many cookies did I eat? A lot more than 0. Or this week or this month or this year, right? So it's the actions that matter. We don't get what we want in life. We get what we earn. I want a 6-pack. If I don't do the sit-ups, I'm not going to get the 6-pack. It's that simple. Even though I want it, I'm not going to get it. In the market, the emotions trump logic 9 out of 10 times. So if fear takes over, and I've seen this, I've been doing this since the 90s, folks. I've seen cycles. 08, I've seen the dot-com boom and bust. I've seen, COVID and traded through all these things. Fear takes over, logic temporarily goes out the window. Because people panic. You walk into a crowded theater, yell fire. You get the same reaction anywhere in the world throughout history. Doesn't matter your language, your religion, your race, the culture, your socioeconomic level, your education, any other thing you could possibly think of under the sun does not matter. Humans are humans are humans. People are going to run out of that theater. So, with markets, same thing. Fear, greed drive markets. It's the emotions. Oh, but Adam, I'm a logical person. I make rational decisions. Show me your actions. It's the first thing I look at. It's not what people say, it's what they do. Because what you do is what matters. I could say I'm the best trader in the world. Show me your performance. I could say I'm the best, athlete in the world. Okay. What's your weight? You overweight or you underweight? Are you at the right weight, so to speak, or whatever? It's just the same thing. It just show me the results. My kids tell me, oh yeah, I'm going to work really hard. What are you doing all day? They're on the screens. Well, that doesn't make sense. Get off the screens. It's real simple. So again, I'm using all these examples and analogies and metaphors and everything else I'm doing just to illustrate the point, right? Point is, okay, if I'm aware that I'm making emotional, not rational decisions, I can shift. I can set up guardrails. Ray Dalio, one of the biggest hedge fund managers and most successful people in the world, talks about this. Setting up guardrails to protect yourself from those emotional decisions that show up and could wreak havoc if they're not controlled. In my book, I've got cartoon characters in it. One is a smart money superhero, guy who's calm, cool, collected inside of me. Inside all of us, we have a good side, a bad side, dark, evil, good, bad, whatever you want to call it. I call it a smart money superhero. And then there's a dumb money beast. And the dumb money beast is the emotional side. So the superhero, the smart one's calm, cool, collected. The rational side, the logical side. And then the emotional side just runs havoc. Think of like a Tasmanian devil. Runs around, causes just in a circle, just goes just crazy. Markets up, buy, sell, down, up, down, and just takes over. The idea is to just pause, reflect, bring out the superhero. Bring out the superhero. Do the right thing. Especially when nobody's looking. Do the right thing. So if we're going to go much lower here, again, I'm not saying we're going to go much lower, but if we do, remember, up, down, sideways is all the market can do. I want to be prepared in advance for any one of those three scenarios to unfold. Up, down, or sideways. It's just that simple, folks. Don't overcomplicate this. So, defense, defense, defense. I believe that's all the time we have left for today. As always, want to thank you very much for being here. Have a great weekend.